Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. I guess we'll start with Happy Halloween, and we'll go from there. So let me welcome my partner, Greg Faranello, all things rate, liquidity, and the Fed. And we are very pleased to be joined again by Joe, who's a second timer with us, which is amazing for us. Guys, it's an important time, and there's a lot of speculation on where the Fed is heading. I say this every time, but again, probably the most important time is the most recent. I'm going to let the gentlemen who are much more qualified than me to get right to it. So, Joe, we want to thank you again for being so generous with your time. And Greg, looking forward to your conversation.
Thank you,
Thank
Michael.
Thank you.
Thanks, Michael. Yeah, it's great to be here. And Joe, we're thrilled to have you here for a second time. We're very fortunate. But before we dive into the economy, would love to get your thoughts on the meeting specifically this week. I know we're priced for 75. There's talk about the Fed stepping down. Now, what are your thoughts heading into Wednesday?
Thank you, Greg. The Fed is going 75. They have become maybe too transparent relative to what Fed watching used to be way back when you had to guess what the Fed was doing based on open market operations. And we've got press reports. There's a very noted Fed whisperer, as someone now likes to call Nick Karamos at the Wall Street Journal, but the Fed clearly had planted a story last week reinforcing, Greg, its forecast from the September FOMC meeting, which showed that the Fed would likely be going 75 in November and then 50 in December to get us a year-end funds rate, the upper band of 450. And that's very much seems to be the case. So it will be a step down in the pace of rate hikes, but still obviously even a 50 basis point move in December is still quite aggressive. It's just that we've gotten used to these 75s in response to what's been very strong inflation.
Yeah, it is interesting. We joke about this a little bit. Not too long ago, 50 was considered to be an outsized move by the Fed. And now we're debating 75 versus 50. And with that, I look at this period of time for me. I feel like to a certain extent, the Fed has put their cards on the table. They've moved rates a substantial amount, financial conditions. I think now I'm more intrigued by where the economy is going to be going moving forward. And I wonder if you can sort of give some insight in your opinion in terms of, obviously we have an employment number this Friday, and where you think the jobs market is going forward. St. Louis Fed President Bullard said essentially that the job market is the crutch for the Fed right now to continue to raise rates.
The problem, Greg, with policy, the way I see it, is the Fed was way too, and this is not just true of the Powell-led Fed, it was the Bernanke and even Yellen-led Feds, where they were very slow in removing policy accommodation, very slow in taking rates off of zero. And what that's caused is leverage and misallocation of capital in the system, of which many other central banks have followed a similar course. If you look, for example, what's happened in the gilt market with the UK life insurance and pension funds leveraging their portfolios to try to get a return because rates were zero there for a long time. What's happened is the Fed now, having seen inflation, now is moving, in my opinion, way too fast. They went way too slow, and now they're going way too quickly, and they're intentionally, maybe they're intentionally ignoring the lags. It seems that way by focusing on inflation. And even Jim Bullard's comment about the labor market typically is a coincident to lagging indicator, and probably more of a lagging indicator this time around, given the fact that COVID and the lockdowns and everything else that sort of destroyed the normal functioning of the economy, the normal timeline, the leads with which you hire and produce, all those things I think have been stretched out and sort of been reversed, because a lot of the hiring decisions this year were probably a function of last year, and you can't find people. So I'm not sure the labor market's the best metric, but as Michael Burry had famously tweeted a few weeks ago, that the Fed's desire not to be the Fed of the 1970s, they're potentially running the risk of being the Fed of the 1930s. Because let's also not forget that not only has the Fed been raising rates, in fact, the rate hikes, other than the 10% increase in rates back in the back half of 1980, of course, funds rate was up near 10% at the time. This is the fastest rate hike cycle ever. And we're also letting the balance sheet unwind. So this Fed has been very aggressive, and it was going to hit the economy. You mentioned transition. To me, it's going to hit it a lot harder than what people are expecting. Now, as it relates to employment, we are slowing. Job growth has been very robust this year, but it's slowing. It should slow further this Friday. whenever the job market produces a negative, almost by definition, it will be unexpected, and you'll get more calls for the Fed to pivot, which I do expect to happen. But again, I would say, Greg, this Fed has replaced one set of policy mistakes by waiting too slow to move with another set of policy mistakes, which is locking them into hiking. And I also might add that when I talked about Nick Teramos in an article in the Journal a few weeks ago, there was also that article, I think, was also there to make people think they weren't going to go 100, because we were starting to price the possibility of 100 at the November meeting. And I think that was designed to, like, if nothing else, at 75, we're not doing 100, in addition to perhaps laying the groundwork for that downshift to come the December meeting.
Yeah, it's been a wild ride this year in terms of watching, the pricing to start the year. A couple of rate increases of 25, and then it was 50, then it was 50 versus 75. The talk of 100 along the way has clearly been a part of the dialogue, and it's really been, in the end, I guess it's all been around inflation. I mean, there are different components of inflation. As you and I know, we look at the labor market right now. I listen to Fed Governor Waller, basically saying right now the Fed has a single mandate, essentially, and that's inflation, because the employment market, they view the employment market as being at full employment. But what's your view? And it is the key, I think, moving forward to a large extent. I mean, what's your view on inflation right now, what we're seeing, how the Fed's reacting, and then heading into 2023 in terms of potential trajectory?
Inflation is definitely too high. It's a major issue for businesses. It's a major issue for U.S. households. That's why the Senate is going to, in my opinion, swing to the Republicans, and also why the House is going to swing to the Republicans by a much larger margin than what people think, despite the fact Republicans have something like 210 seats, and that's largely because of inflation. So it's a major problem politically. It's a major problem for standards of living. However, you have to understand the context in which we have this inflation. We have way too easy monetary policy, and we have way too easy fiscal policy. And we had different shutdowns, not the least of which came from China, which there's still potentially those rolling shutdowns, which have hurt the supply and production of goods, which has bid up the price and such. But again, inflation's a lagging indicator. And I want to note, Greg, if you look at the markets, if you look at the forward indicators of inflation, even when the market thought back in the spring, the Fed may stop at around a 3% funds rate, the market was never saying the Fed didn't have credibility. The market was never saying the Fed had to do more. And you see that from the fact that the dollar's been strong this year. You see it in the fact that the yield curve has continued to invert. If you take the 2 to 10-year note, adjusted for the level of rates, it's never been this inverted. And inflation expectations during this whole time have been very stable. So it'd be one thing if the market was pushing the Fed to go more aggressive. It seems like the Fed, led by people like Chris Waller, who's definitely a spokesman for Jay Powell, have really been trying to just bang on the point that inflation, we have to get down. And it will come down. But the problem is, if you're needlessly causing what I think could be a deep recession, that's not the best approach. The Fed should never have said transitory. The Fed shouldn't have gotten hawkish right after Powell was basically given the verbal that he was going to get reappointed. And the Fed should have taken a more holistic, granular approach in reinforcing the fact that they will continue to hike as necessary, be a little bit less transparent in that they don't know where the economy is going. They don't know how to predict things. This is very difficult business. Instead, they've been singularly focused, again, on that price mandate. And I understand why they're doing it. But in my opinion, Greg, they're risking a very hard landing and making another huge policy error, but in the opposite direction.
Yeah, I agree, Joe. It's funny. We look at the yield curve. I know we all look at 2s, 10s, and that's been inverted for a long time. You look at 3-month 10-year, and back a number of months, the Fed was pointing to that part of the curve saying, look, it's still positively sloped. But the challenge is the 3-month 10-year reacts to Fed tightening. That's right. And the reality of those rate increases flowing through. Yeah. 2s, 10s, definitely a much, I think, granular reflection of where the economy is at. Now they're faced with the exact opposite dynamic because we're moving into inverted territory.
Right.
So,
I mean, if there was, here's the thing: if if we talk about inflation, inflation's a problem. It's a major problem. However, if you look at the markets, the fact that, again, as I mentioned, inflation expectations are stable and the curve is inverted, the long bond, the long end of the curve is telling you it's not worried about inflation. If that wasn't the case, then the curve wouldn't be inverted. The other thing, as you know, Greg, and what should be highlighted is that not only does the yield curve predict, or not only is it a good predictor of recession, but also causes recession, because when the curve is inverted, the cost of funding is high relative to where you could lend at. So it actually disintermediates and causes credit and liquidity creation to dissipate, to evaporate, to leave the system. And therefore, you're right. The longer, we've had a long period of time where that 2s10s has been inverted. That's actually hurting the economy. But again, you don't feel it in real time. It's going to take a few weeks, months, and quarters for it to be felt. And of course, Greg, when that happens, the Fed will then probably pivot way too far in the direction of easing. And this is what they've done back in the 60s and 70s and 80s and 90s to some extent, where they go from one end to the other. But I think this time around, they're going to be more, it's going to be a bit more violent, a bit more extreme, and a bit more damaging.
Yeah, we move in and out of these cycles so quickly, right? I mean, when
right.
You've seen, right, you see the mark-to-market repricing in 2022, you look at what went on with the UK pension system, we've been writing to clients, like, you have to understand this mark-to-market move, portfolios just don't have time to recalibrate to the magnitude of the move that we've seen. So it may not be the absolute end game, but the speed in which we move there, I think, is unlike, as you and I know, anything we've ever seen.
Yeah, and it got me thinking too. If you look at the 60-40 portfolio, if you try to synthetically create it back 100 years, you've never had a drop like you've had. So there's been nowhere to hide. But importantly, I get worried that, we talk about the economy. I mentioned hard landing. I worry about systemic risks in the system that have been built up from these low rates and this leverage, that you could have a financial crisis or a financial accident, which would be very destabilizing. And that would happen in part because of the Fed's actions, which have encouraged risk taking for so long. When you give free money, people generally tend to do some dumb things over time. And that's certainly might be proven to be the case yet again.
Yeah, no, I wrote to clients this morning, Joe, with sentiment of that, to say, think about a time and place where the economy was weakening, right? And you had central banks around the globe tightening policy. And then from the other side of the spectrum, from a capital perspective, you've also got this notion that the Fed or central banks are no longer there to necessarily cushion the blow, at least short term, as things start to turn down. And we're seeing that obviously in risk assets across the board. But this is certainly new territory. And I appreciate your insights. I really do. And I really appreciate you coming on today.
Yeah, thank you. Well, I want to just add one point you made me think of, Greg, and that is this is the only time the Fed has been raising rates when the index of leading indicators is negative year on year. So again, just to drive home that notion of the Fed being super aggressive and perhaps irresponsible in terms of how aggressive they've been, they've never hiked rates when that index has been declining year on year. So you don't generally want to hike into a growth slowdown.
Absolutely. We are in uncharted territory for sure. And thank you for that note. Michael, I'm gonna pass it back to you if you don't mind, my friend.
Yeah, thanks, Greg, and thanks, Joe. I guess I have one quick question as we end up here. Is there, it looks like it's going to be 75 and then 50 and maybe 25 in February or whatnot. Do you guys see maybe the Fed easing in 2023?
Yes. My best guess is the Fed is not hiking past December. And if my forecast of growth is right, forget the financial potential crisis aspect, which I hope I'm wrong on for obvious reasons. But given where I see growth and then where I think inflation will be by the middle of next year, I would see, Michael, a pivot sometime in Q2. So they start easing in Q2 of next year, which is historically consistent with the record where the Fed generally goes from the last hiking to the first easing is generally within 6 months. And I expect history to repeat yet again.
That's fantastic. Thank you so much. Well, guys, as always, it's just great to sit here and be listening on just wisdom. I think it's great for our clients and for anyone else who's listening in today. Joe, again, thank you so much for your generosity of your time. Beyond grateful. And Greg, you know how I feel. I say this every time. We've been doing this a long time together. It's one of my favorite times of the month. So thank you. And for our clients who've been pounding on Greg's door lately, he's still available and willing and happy to jump on the phone or respond to any questions you may have. Wish everyone continued health and happy Halloween to all the youngsters out there.